Join over 5,000 attendees for the largest AI event in Asia, Super AI in Singapore, June 5th and 6th, 2024. Edward Snowden, Benedict Evans, Balaji Srinivasan, and over 150 others will hit the stage, joining the industry's most influential to explore and unveil the next wave of transformative AI technologies. Singapore will become a vibrant AI hub for a full week from June 3rd to the 9th, with over 150 side events that will make for unparalleled networking opportunities. Visit superai.com for 20% off tickets with the code REALVISION. Look for the link in the description. Is the Fed's plan finally working? Hi, everyone. Welcome to the Real Vision Daily Briefing. With me today is Chen, author of Fidenza Macro Research. Hey, Geo. Welcome back.
Hey, Maggie. Thanks.
It's great to see you. So if we look at the action today, the stock rally that roared through November has kind of stalled here this first week of December. The Dow and S&P a little bit lower today. NASDAQ a little bit higher at last check. But, no real moves. Russell down. And that despite the fact that the Treasury yield dipped below 4.2%. And then Bitcoin really stealing the show, continuing to charge higher, briefly topping 44,000 before settling back. So a lot to unpack here. Let's start with the economy. The move lower in Treasury yields, partly triggered by headlines that cross that job openings fell by more than expected in October. We seem to be getting this sort of steady drumbeat now of accelerating weakness, if you could say that, at least in some indicators. What's your assessment of the U.S. economy, Geo? Has the Fed managed to get that slow things down and get inflation moving lower?
Yeah, it definitely seems like we've reached an inflection point in the economy where the numbers are getting consistently softer, especially in employment, which is what the Fed wants to see. And we have seen the Fed speakers come out and almost pat themselves in the back and acknowledge the softer numbers and say that their goals in inflation are being met. And we're actually going to be below the Fed's September projections on inflation. Likely going to be below coming into December. So they're ahead of schedule. And it definitely feels like they are in the pilot seat. They're in control of the economy. And I think it's going to remain that way for a while as inflation continues to trend lower.
So the market sentiment has been the minute they see that, they kind of immediately go to cuts. And they've priced in quite a few for 2024. We're going to get a Fed meeting in December where they're going to have a chance to be able to kind of, think about their messaging. Okay, so things are slowing and that's great, but does it look like they're going to be able to hit that soft landing or sort of moderate slowing, or are we headed for something steeper and potentially more painful that would warrant talk of rate cuts?
Yeah, I do think that we're very likely to get a recession, and the question is how deep and how long, and whether the Fed is going to be able to put the bottom in and keep it from getting too deep. So for now, it seems like the Fed is in control. Like they have a lot of room to cut, and there's also a lot of dry powder out there in money market funds, about 6 trillion. It's gone up since COVID by about 1 trillion. So there's a lot of cash on the sidelines ready to buy the dip and risk assets and help keep sentiment supported. So as long as we don't get some kind of unexpected exogenous event like COVID, I think the recession is going to be pretty mild. And as long as the market believes the Fed is in control, bad news should continue to be good news for the market.
Do you think the Fed is going to want to, AJ asking, do you think this Fed meeting could be a nothing burger? I mean, it kind of feels like that, especially as you get to this time of year, because as long as things are steady, nobody really wants to mess it up, right? But do you think the Fed's preference would be to really try to message that they want to stay here and keep their powder dry until they figure out what's going on, because we still don't know the sort of lag effects of all the tightening, and on the flip side, the resilience of the US economy, everyone's kind of gotten that wrong. So would the Fed prefer that the market not get ahead of itself again on this idea of rate cuts? How do you think they're going to handle that balance?
Yeah, that's a really good question. Um, of course, we have the dots coming up,
Mm.
and the last dots in September were really hawkish. And now now the market is pricing in, almost five rate cuts for 2024. And it's hard to see the dots getting to that level to go from, 50 basis points all the way down to, 100 or 125 basis points. Um, so that's a risk for the market that could certainly trigger a bit of a pullback. But on the other hand, the fact that the Fed is ahead of schedule in getting inflation down, that's positive. And we've had a bunch of Fed speakers come out and speak out on the dovish side. Now, I don't think that would have happened without Powell's endorsement. So, we could get a combination of maybe hawkish dots that are not really moving down to meet the market, but some pretty mild or dovish sentiment, and dovish enough to keep the market going.
Yeah, kind of split that difference, right? And
Yeah.
then we're all left figuring out, do we listen to what they say or do we look at the dots to see, which is going to come out on top? So in this environment now, we're the Fed's done, everyone seems convinced. Now it's a question of when do they ease, not that concern about interest rates, which really plagued the market through 23. So in terms of this investment landscape, let's walk through how you're thinking about some of these assets. And I'm curious in this disinflationary regime now, how you think about bonds. Would you be buying bonds here? I mean, this is the trade that killed everyone in 23, right? That trying to sort
Yeah.
of time that bond trade and then rates ratcheted back up again. People got their face handed to them. Um, so I think probably a little bit of reticence or there's a little fear in there, but would you be buying bonds here? And if so, what kind of duration are you looking at?
Yeah, earlier this year I was bearish in bonds due to just the higher for longer regime and all the supply that was coming on. And since then they've reversed pretty dramatically, both the long end and the short end. Uh, you know, Pretty recently, I think the conditions were met for durable bond recovery.
Mm.
Um, there's a wide consensus that the Fed is now done, even though they haven't outright gone out and said that they're done. But the economy is weakening enough for them to kind of just be on hold for a while, and for the next move to be a cut. So I think bonds are going to do well over the course of the next year, because if inflation goes down to 2% or even lower, I mean, we might even see a one handle in inflation this coming year. Then the Fed is going to have to cut in order to keep policy at the same level of tightness.
Mm.
So if employment is kind of ratcheting up to 4.5%, do you really want to have Fed funds at, let's say, 300 basis points above inflation by mid-year, which is very well where it could end up? You don't want to be in that situation. So I think they're going to have to cut at some point.
Mm. I know you're looking at the US versus Europe. And this is something that's come up with others as well. Where is the US slowdown versus Europe? And you have bunds on your radar. Talk to us about that.
Yeah, that's right. It's interesting because Europe and the German economy are kind of 1 to 2 quarters ahead of the U.S. in terms of their journey on coming down from inflation and into disinflation. So inflation is coming down a lot faster. And what's interesting is that, even though the Fed is still going to be, the Treasury is going to be spending a lot of money next year, and supporting the economy, but Germany, they just discovered a 60 billion hole in their budget, from a recent German Constitutional Court ruling saying that they can't, 60 billion that they thought they could spend can't actually be spent. So that's going to put a big hole in their fiscal spending, and that's going to slow the economy down a lot. And as if you could see in slide 1, Germany's fiscal deficit is going to actually get cut by a lot more, and they're actually going to be close to flat in terms of their deficit over the next few years. So that fiscal tailwind is probably the smallest in Germany than it is in other European countries as well as the U.S. And that also means there's going to be less supply of bonds too, which, as we know, is pretty important. So you have this dual tailwind of not too much supply in bonds, as well as slower growth due to fiscal headwinds.
Do you think the ECB starts cutting before the Fed?
Yeah, I think it's quite likely. They're a little bit more balanced in terms of how in terms of their determination to fight inflation, more balanced than the Fed. So I think if given the opportunity, given the excuse to cut, they certainly will.
Yeah, it's interesting because they have, they have to sort of, this has always been the difficulty, that manage so many different regional economies. So while they might want to cut based on what you just described in Germany, will they be able to based on the readings coming in from everywhere else? It's always the tricky thing for them. So, great question from Dan. If yields, and we're back to talking US, if yields decline, which I think we've established we expect that to happen because of a recession, will that impact stocks negatively? Can stocks and bonds both rally?
Well, they certainly have been.
They have
That's
been,
what's
but
been
can they
going on.
continue? Because I think,
Yeah.
this is what everyone's saying. If yields are moving lower, bond prices rallying, it's because there's a recession coming. But is that good for stocks?
Yeah. Over the past year, we've had this back and forth between disinflation and stagflation. So stocks and bonds going up at the same time, and then stocks and bonds going down at the same time. I do think that now that we are a lot closer to the Fed's target, this period of disinflation can be a little bit more durable, especially now that the employment picture is at an inflection point. So to answer the question, I do think that they can keep going as long as the market believes that the Fed is still in control, that whatever happens, whatever weak data comes out, can be, I guess, can be supported by further Fed easing.
And if it's a shallow, this is why that soft landing is the unicorn, right? Because if it's a shallow recession, then the economy is still holding up, even though rates are going down. That's a good scenario for corporations, especially anyone who has to hit the capital markets again with those lower interest rates. So you could see how in that kind of environment, with a supportive Fed and an economy that's weakening but not falling out of bed, that could be a good scenario. So we've seen this sort of stalling of the rally. Not surprising, given how fast and far we came in November. I mean, it's such a powerful rally. Do you and by the way, for those of you listening last week, you'll remember most of our analysts were warning of this sort of period of indigestion or consolidation based on the fact that things had kind of maybe overshot. Do you feel like the U.S. equities can regain momentum here into year end, Gio?
I think a lot is going to depend on the data coming up as well as the Fed meeting.
Mm.
So we have the employment number, the CPI, and the Fed meeting all within the space of a week or so. And that's going to determine the direction for the market. I do think, I believe the seasonals for equities start to turn quite positive in mid-December. So that could be a tailwind. So we'll see.
Yeah, AJ, I think that answers your number. Yes, non-farm payrolls will be
Mhm.
will be very important. And everything now, it's not just directionally, it's how much things are either weakening or surprising on the upside that I think is going to matter, especially in the run up to the Fed. So, wanted to make sure that we touched on Bitcoin because this is also on your radar. I mean, it's on everyone's radar because it's been rallying so strongly, especially at a time when we've seen some sideways action in a lot of these other markets. We've seen Bitcoin really breaking out. What do you make of this, and what are you watching there?
Yeah, sentiment really got bombed out this year, to the point where it just couldn't go down, regardless of a lot of negative events for crypto. And now we have this BlackRock ETF, the speculation that it's going to go through. Um, Everyone I've spoken to, and a lot of the research I've done seems to point in that direction. And just today, it looks like BlackRock filed an amendment in their S1 with the SEC, which seems to signal that the process is moving along. So that's going to be a catalyst and a bit of a upside magnet for Bitcoin. And then we have the halving coming up as well in the first half of next year. So we have these two really positive catalysts for Bitcoin coming up. And on top of all that, the global macro conditions for Bitcoin and crypto in general to go up have been restored, in the sense that we really needed the Fed to stop tightening, and we needed some kind of clarity on when the tightening cycle was going to end. So now we're finally getting that, and so the pace of financial conditions has gone from accelerated tightening to almost accelerated loosening over the course of the last couple of months.
Yeah. So do you, in your mind, does Bitcoin trade in correlation with risk assets still, or is it sort of taking on a new dynamic, especially with that ETF coming?
Yeah, it's so I wrote a piece in my last in my blog, kind of comparing gold to Bitcoin, and gold actually leads Bitcoin by anywhere from like 1 to 7 months, and that's because gold tends to be a lot more sensitive to financial conditions. So as we know, like, gold is now close to the highs, uh, trading very strongly, and based on seasonals, you can see here in the first column, it could very well continue higher into January and into mid-Feb. And that's a strong signal for Bitcoin. It's telling the market that the conditions are right for Bitcoin to keep going. So what I was saying is that monetary conditions kind of create the green light for Bitcoin, and then it's the market's predictions of further adoption, and the size, the growth of the network that drives the bull market higher. So we have the conditions, and then we have the upcoming approval of the ETF, which is going to drive adoption higher and kind of solidified Bitcoin as a as an institutional asset.
Mm.
So we have all the ingredients for new bull market.
Yeah. It's so interesting. We had Peter Brandt on the platform. I mentioned it yesterday. I'm just going to reiterate it for those who uh, didn't catch that. He is on our show, Three Ideas, and one of his picks is Bitcoin. He made some very bullish calls. As you know, Peter is a really, really long time veteran technician. He walks through his different charts to underscore his reasoning behind that. If you have not watched the episode, I highly recommend you do. If you are on YouTube and you are not a full Real Vision member, go to the website and jump on one of our offers so you can see that Peter interview, as well as take advantage of the Crypto Academy that we just launched to help educate everyone around this new cycle. It's learn the mistakes of the past and be smart about it this time. And Geo, one of the things that Peter pointed out is this is an asset that moves unlike other assets, like parabolic moves. We also know, based on what happens in the past, that there's volatility around this. So do you approach this differently than other asset classes? Do you look for sort of protection? How do you think about that?
Yeah, absolutely. So that was a great episode, and I think Peter has some great insights of the market. I also follow him as well, and the cyclical nature of crypto is extremely powerful because when when people get in at the bottom of the cycle, the the returns are just like unlike any other asset. But then if you get in at the top of the cycle, it can be completely, I mean, you can just get completely wrecked. Um, and I believe it's cyclical because it's a very psychological um, asset class.
Hmm.
Like it trades very emotionally, and humans just go through all the cycles of like euphoria down to despair and back again. Um, but what underlies the cycle is the constant growth and development that happens, in crypto, in Bitcoin, and that's what kind of makes the every cycle reach a new, like a higher high and higher low.
Yeah. No, that's really well put. And it's important to sort of arm yourself with information and learn about this. One of the things I love Peter talking about is the fact that, Raul actually introduced him to it and he looked at it. But, we have a lot of people who just say, oh, I don't understand that stuff. But he dove in and was paying attention and experimenting and really trying to wrap his head around it. And it is different. Listen, some commodities move like this as well. So, and it's a brand new market, right? So we're all on a learning curve. But it's really fascinating and wild. So I hope that everyone keeps an open mind and dives in as we all do to try to watch this really sort of interesting development. What about traditional gold? So you're bullish Bitcoin. What about traditional gold? Do you feel like that's going to break out because it had that moment and then now it's sort of, I think, sitting at this resistance level? Everybody wants to see if it can make that run higher now.
Yeah, it's been an interesting week for gold. It kind of painted an ugly candle on Monday, having broken out to all-time high and then reversed pretty violently back. But what's interesting now is that it tends to follow real yields, and right now it's trading pretty cheap relative to real yields. Real yields right now are at the low for the cycle, whereas gold is well off the highs. So I do think that gold is going to kind of find the bottom soon, and the next time it reaches that 2070 level in spot, I do think it's going to run. So the seasonals also start to turn very positive in mid-December. So I'm looking at that. As long as the numbers and the Fed kind of play ball, then I think gold is going to keep rallying.
Uh, we've got some great questions in here, so I want to make sure I get to them. And of course, a lot of our viewers know that you join us from Singapore, so they're very curious to get your thoughts on China. Moody's cut China's credit outlook to negative today. I mean, it's a rating agency. Some people wonder whether that really matters, but okay, they did it. But there does seem to be growing concern about the government's policies in terms of dealing with the debt and slowing economy. We had Paul Hodges on yesterday. He was very bearish about the situation in China. What are you seeing? What's the talk over there, Geo? Uh, Ched asking, can you give us any insight into when you think China might um, trigger the expecting massive liquidity pump to mitigate their economic crisis? Will they come in and stimulate? With the US dollar drifting lower, seems like an opportunity for China to do more cowbell with crashing yuan and help pump things up, maybe pump crypto. I'm not sure that connection, but anyway, give us your thoughts on what that's all
Yeah,
about.
yeah. You know, China has been really hitting that cowbell, but nobody's listening. The market's not listening.
Mm,
Um, but
that's
what's
worrying.
interesting, yeah, the what's interesting is that the data has been surprising to the upside as well. So I think there's a disconnect between
Mm,
the stimulus and the economic data and the market. And I think at some point that disconnect is going to resolve itself, um, and to the upside in the market. Now, I've heard that there's probably a lot of tax loss selling going through, which could be why it's depressing the market so much. But if Chinese indices suddenly rip in the new year, I would not be surprised. So this is something I've been looking at for my own portfolio.
very interesting. So that answers your question, OTDE DGen, because he's asking, will China ever be a buy? The HSI is in free fall. So you think China is stronger than people think, or you just think that the Chinese are willing to pump liquidity and to see if they can make a difference, or both?
Um, I think China is not as weak as sentiment
Hmm.
says it is, and yeah, so I think there's the stabilization of the data, which is a good sign, and it's not being priced into the market. I think sentiment is more, you know, more bombed out than I've ever seen it in my career.
Yeah, which when that's the case, you always sit up and take notice. Very interesting. So, want to squeeze another one in here. What's your view? Trillion asking, what's your view on euro dollar and dollar yen?
Yeah, so euro dollar is interesting because you have, as I said earlier, like the European economy is probably slowing faster than the US. So because of that, like, that should be bearish for euro. But at the same time, the disinflationary trend in the US is going to have a pretty powerful effect on the dollar too.
Hmm.
So I do think that what's going to end up happening is that the effect on the US dollar is going to slightly outweigh, and we're going to have a probably a grind higher in euro dollar. Um, as for dollar yen, that mostly follows US yields. So uh, if if inflation does go down, like I believe it will, and if the Fed cuts, then dollar yen should be lower, next year.
Yeah, that's so interesting that you said that about the euro because if I'm not mistaken, we had Dale Pinkerton, I believe, is the one who pointed out the same thing. It's just the momentum for the dollar bear trade is going to be stronger. Stronger euro, not good for Germany or not good for Europe, whose economy is weakening, and any attempt to sort of help out on the export front. That's sort of potentially an added negative for Europe, isn't it?
Yeah, it certainly is weakening. And if you look at my slide 3, uh, unemployment in Germany is closer to the post-COVID high than it is to the cycle low,
Mm.
which is quite striking. And it's not going to get better until we see the global economy trough and the ECB cuts rates and comes to the rescue. So um, I do think that what the scenario we might see is that euro weakens on the FX crosses, but strengthens against the dollar.
Mm. Yeah, interesting. So if we sort of wrap things up, Gio, what do you feel most convicted about here as you're looking at this turn into 24?
Yeah, so I've mostly been looking at right tail trades, betting on disinflation. So and because crypto cycles could be quite powerful, I'm positive on both crypto and equities, but I do think that the juice really is in crypto right now. So I've been looking at calls on crypto related equities as kind of those right tail, like lottery ticket style return profiles. And
it tells everybody everything they need to know about whether it's right for their risk profile. So I'm glad you said it that way.
Yeah. And also one interesting thing is the regional bank ETF KRE. It has been beaten down after the Silicon Valley Bank incident. But if the Fed starts to cut next year, what we're going to get is a re-steepening of the curve. So, banks got hit because we saw a massive bear market in bonds and a deep inversion. So I think the reverse of that is going to happen in 2024, which means this should be really supportive for KRE. So as long as the economy doesn't fall out of bed, and we don't get some kind of like banking crisis, then this should all be very, very positive for KRE at some point.
Well, that's going to be music to the ears of some people, certainly, who are very concerned about that. Geo, it was so great to catch up with you. What a fantastic conversation. Thank you so much.
Yeah, it's good to chat again.
Yeah, absolutely. Always great to get the view. And we always appreciate you getting up because it's basically the middle of the night. But we appreciate it. Thanks so much. And so interesting. Glad to really get that sort of full conversation about Bitcoin and have you share your thoughts on that. We are doing a live crypto academy. It's not exactly a festival of learning, but it's sort of a live academy. We're going to do 2 days next week, everybody. So keep your eyes out and we'll keep you posted. Bring you as much information as we can, since it's getting on a lot of people's list for their top trade as we turn the year. So we're going to dig into it. But Geo, thanks so much. And if we don't speak to you before the holidays, have a wonderful one and Happy New Year.
Yeah. Happy holidays to you too.
Thanks so much. Thanks, everybody. We'll be back same time tomorrow. In the meantime, take care and good luck out there. Join over 5,000 attendees for the largest AI event in Asia, Super AI in Singapore, June 5th and 6th, 2024. Edward Snowden, Benedict Evans, Balaji Srinivasan, and over 150 others will hit the stage, joining the industry's most influential to explore and unveil the next wave of transformative AI technologies. Singapore will become a vibrant AI hub for a full week from June 3rd to the 9th, with over 150 side events that will make for unparalleled networking opportunities. Visit superai.com for 20% off tickets with the code REALVISION. Look for the link in the description.